You can go ahead and start.
My name is Joey.
I'm Isaac.
I'm John.
I'm Alex.
And today we're going to present Arista Networks. So today we're going to do an overview of their business and revenue structure, the risks associated with the business, their key financials, key growth drivers, our valuation of the stock, how it fits in the portfolio, and then our recommendation of a buy following a summary. First of all, Arista Networks is a networking equipment provider. So what that is, they sell Ethernet switches and routing equipment to cloud computing companies. They also offer subscriptions to their extensive operating system, which I will explain in just a moment. And a few key points about the business: they have strong business relationships with other major corporations like Microsoft and Meta. And they operate within two high growth industries, cloud computing and AI. So cloud computing is the delivery of computing over the internet. That includes servers, storage, databases, networking, software, analytics, and intelligence. So it offers faster innovation, flexible resources, so they can tailor to the needs of each individual company. It's easy to scale their products. They offer switches from 10 gigabytes to 400 gigabytes. The more gigabytes, the more information that can flow through. And it's cheaper than the traditional databases are. And then their EOS, their extensible operating system, it simplifies the product upgrades. So when companies need more or bigger network switches than they have currently, it's easier for them to upgrade. It helps identify any faults in the network, and they're self-healing, so there's no downtime really, which is very beneficial for the cloud computing companies because downtime will hurt profits in the end. They're openly programmable, so it can tailor to the needs of whatever company that may be, whether it be the large cloud titans like Microsoft and Meta, or if it's their smaller $1 million, $2 million customers. And another thing is they have increased connectivity. So it helps bring all the devices together onto one large network. So right now we believe they are slightly undervalued after a recent earnings call, which caused their stock price to dip this week. We are recommending a buy, and the reasons to buy is their high growth potential, the diversification it adds to the portfolio, and the future customer orders that they expect. So like I said before, we're recommending a buy of 85 shares, and we believe that can be done with the cash that's in the account, or if we decide to sell more communication stock, there should be funds available to buy. So our current price that is $135.45. But the target price is $176, so that gives it a 34.4% return. So their business is in the network, hardware, and software. Some of the challenges is maintaining a constant growth rate from their large cloud customers, because Microsoft and Meta account for about 40% of their sales. And some opportunities that they have are in the cloud computing and AI industry. So for their key driver, that's their current main source of revenue is in the cloud computing industry. And then for the artificial intelligence, since it's so new, they have a chance to capitalize and make their name known in that industry. Some of the risks involved are the intense competition. So their main competitor is Cisco. Arista is about a $43 billion company, while Cisco is about a $200 billion company. Supply chain restraints have caused them issues in the past, making their products more expensive to manufacture. And in the end, their net profit margin has gone down. And another risk is their inability to acquire new customers. So that's a large part of why they are a high growth stock right now, because they have large cloud computing customers. So they need to meet those expectations in the future. So here's a graph of their current stock price over the past year. As you can see, it's generally been in an upward trend, but again, after a recent earnings call, their stock fell about 15% on Monday. And then figure 2 shows some of the key financials, their PE, their ROE, and then their EPS over the past 3 years and the trailing 12 months. So their product revenue over the past 5 years has been growing at a 23% rate. You can see in 2020 that they had a dip in that because their large customers did not re-up on, they didn't upgrade their network switches, which caused a hit to their revenue. And then it accounts for 84% of their revenue overall. Their service revenue, that's been growing at a more steady rate. There's not much fluctuation with that. And it accounts for 15% of their revenue, and it's had a 26% growth rate over the past 5 years. And then here are pie charts of their revenue in 2022 and 2021 based on service and hardware. So their hardware was 85% and their service was 15% in 2022. And their hardware in 2021 was 81% and their service was 19%.
So going over their ESG, some of their pros and cons, starting off with the pros, they're creating an environmental management system in EMS that lays out objectives for achieving pollution, prevention, environmental protection, and more. They're committed to building an inclusive and diverse culture that encourages the voice of their employees. They've also given back to the community by donating through charitable funds, supporting numerous nonprofit organizations. And their good governance promotes high board effectiveness, which can lead to better decision-making. Some of the cons that we found were the cost of implementing an EMS. This could be costly in both of terms of time and resource. And too much focus on their governance can lead to a lack of flexibility and agility. Summarizing their ESG, we rate this company favorable based on their ESG, with their strengths in environmental sustainability, good governance, and their promise to be strong financial performance, expanding their customer base, and commitment to innovation. The chart we added here is just shows their diversity in the board members.
Beginning to take a little bit more of a look at their risks and using this risk matrix, we can see the biggest thing we're currently worried about is the intense competition of the industry in which they operate. As Joey had stated earlier, one of their biggest competitions is Cisco, which is about a $200 billion company, while they're only about a $40 billion company at this moment. So competing with a company of that size that's been around for as long as Cisco and has as many connections as Cisco does and is built up being within that industry will be very hard, as well as their inability to currently attract new large customers. A large portion of their revenue currently comes from a very small amount of customers. About 40% of it comes from Microsoft and Meta alone. And the other main concern of ours is the unpredictable sales cycle, as a lot of their sales and revenue amounts do come down to whether or not companies decide to upgrade the current equipment that they have or change to different services that they're offering. So those are some of the main risks that we're focused on. When we start to look a little bit at some of their key financials, we'll start with down here with their profitability ratios. We can see they're all much higher than the industry standards, especially their net profit margin. And also when we compare their debt to equity ratio to their competitors, as well as the industry average, we can see that they use very, very little debt to fund what they are doing. As well as currently, when we look at their PE, it is quite high in comparison to the other companies within the industry, but we believe that's due to them currently being in a high growth state and at that beginning stages of that. And that's the same reason for their current low PEG and why we believe the PEG will increase as we go forward into the future. So starting with a little bit of our first driver for growth is cloud computing. So Arista Networks provides cloud networking solutions that get used in data centers and other high performance computing environments. These systems that they provide to companies are extremely automated, highly resilient, and also extremely scalable, as Joey had mentioned earlier, going from 10 gigs all the way up to 400 gigs. They currently have cloud partnerships with some of the biggest cloud computing companies in the industry, being Microsoft, Amazon, Google, and many others. Arista uses a cloud native approach when designing many of their products, which means they design their products specifically for the environment that they're going to be used in, rather than having just a general kind of overview of how they implement things. They go into each individual company and look at what are their needs and go about how can they best help those. And to help generate that cloud native approach, they very heavily use cloud analytics in determining what their approach will be with different companies. Looking a little bit more at just the numbers around cloud computing, assuming that they are able to maintain their market share or even grow it, we believe that cloud computing will be a huge driver for growth, as it's an industry that overall has been growing a lot recently. If we look at some of their key customers, the Microsoft's cloud computing has grown at 53%, Amazon's has grown at 37%, and Google's has grown at 45%. And using the previous 5 years, ANET's has grown at 23%. And looking at the overall industry of cloud computing, it's expected to grow 20% a year for the next 6 years.
Now, going on with their driver two, being artificial intelligence, they provide high-speed switches that handle the massive data flow. They worked with NVIDIA to create an AI-ready network switch, which that are meant for their GPUs that help build ChatGPT. Their biggest customers, as mentioned before, are Meta and Microsoft. And as Isaac mentioned, profitability will increase with cloud computing and AI. And then going on forward, recently their earnings call on Monday, they announced that they will be having a 400G to 800G network switch. So with that excitement, we expect companies to start buying their AI hardware next year, and also having their largest customers coming back and buying it again. We expect roughly $1 billion in AI revenue in 2024, and after that, a constant growth of 20%.
So moving on to our valuations from our two drivers, we have cloud earnings growing at 12% a year, which we think is very conservative. Our AI earnings is difficult to estimate just because there's no real data for the past in the industry. I'd also like to point out that in 2026, AI makes up a relatively small portion of the total EPS, but we get there within 3 years of AI growth, and we think that that can continue to grow in the future. So then moving on to our we have our baseline growth in 2023 at 18%. Then it's going to decrease 2% a year with a terminal growth rate of 8%. And then on our optimistic, we start off with a 25% growth rate in 2023, then a 20% growth rate in 2024, and then going down 2% a year with a terminal growth rate of 9%. For our pessimistic scenario, we have a 12% growth rate starting in 2023, and then it decreases 1% a year with a terminal growth rate of 6%. So moving on to our PE estimates, we do have our 1 year ahead PE increasing slightly. This is because the excitement around AI, we think that Arista Networks will be valued more favorably, which we came up for our baseline. We came up with a 1 year price target of 166. For our pessimistic, we have it increasing, just not as much. And we have a price target of 143. And then for our optimistic, we have it increasing the valuation of the company, but due to an increase in earnings, we do not have it increasing as much as the baseline. And so we come up with a price target of 172. For our discounted cash flows, for our baseline, we have an average value of 194. For our pessimistic, 108. And then for our optimistic, 319. And then our combined target, we used a 65% weight on the price to earnings and then a 35% on discounted cash flow. And we got a 176 baseline, a price target of 131 for our pessimistic, and for our optimistic, 223. And they currently have a price of 135. So moving on to our portfolio fit, Arista Networks has a total correlation with the Spellman fund of 0.506. We were concerned that some of their highest correlations was going to be with their biggest customers. As an example, Meta and Microsoft make up over 41% of Arista Networks revenue in 2022. And so we were concerned that they were going to have very high correlation since those two stocks are in the fund. But as you can see, Meta has a correlation of 0.38 and Microsoft has a correlation of 0.51 with Arista Networks. One concern that we also have is this will be increasing the number of cloud computing companies that we have in the portfolio. But we believe that cloud computing is so strong, it is so important to the economy that we don't believe it's shrinking. We don't see it shrinking in the future. So to sum up, we have artificial intelligence growth that we believe will be very strong, but it's difficult to find a good price for that. So we use pretty conservative estimates in our valuations. And then cloud computing, we expect very consistent and high growth. buying Arista networks would also gain exposure to hardware. They're also highly profitable and have low working capital requirements. We currently advise a buy. We are recommending a purchase of $11,500, which is $85 worth of Arista networks, or 85 shares worth of Arista networks. This would make up 3% of the total fund. This will bring the Spellman technology sector to the same weight as the S&P 500. We recommend using cash, or if we don't have enough cash, we would recommend trimming our holdings and communication services to fund this purchase. And once again, we have a current price target of 176, and this is a roughly 30% increase. And with that, we'd like to thank you for your time listening to our recommendations, and we'd like to open it up to questions.
You go to slide 15. Okay, so you talked about partners and you talked about customers. So when we talk about Microsoft, NVIDIA, and some of those as partners, are they customers, providers? Are they joint on some of these relationships? How does that work when we start talking about the cloud? Who's their ultimate customers? It's not the Google Cloud, it's
Companies like Microsoft, Amazon, Google all purchase like network clouds like solutions from Arista.
Continuing with that, they do have technology partnerships. So like, for example, like Microsoft will like tell Arista networks what they want like in the future. And so then they can work together to have better products down the line.
when you talked about the chip going from 800 to 400 or 400 to 800. Is that consistent with what Cisco and Juniper are doing? Or is this going to be faster? Or better, work faster?
Yeah, so they're 800, that's brand new. They just released in their earnings call on Monday. So I'm not sure. Cisco has a 400G, and then Juniper, I believe, just has a 200G. So Cisco, if I had to guess, they'd be rolling out with something very similar to this soon. I haven't looked into their what their new releases are, but they do have a 400G switch.
And do we know if those other two have the same? So NVIDIA is the one you always hear about in the cloud with their chips. Just part of the reason the group wants to sell Intel and why it's down 35% is they just can't keep up with some of the chips are coming out of there. Are Cisco and Juniper also partnering with NVIDIA, or do they have sort of a exclusive relationship with the big dog now?
I'm not sure if they have partnerships with Cisco or Juniper. If I had to guess, Cisco, they probably do have partnerships with other people, but I can't guarantee if it's just with NVIDIA or not.
And then this is more of a just overall philosophical. So it's a high PE because it's higher growth, but they're having a hard time adding new customers, and 40% of the revenue comes from two names. So we've got concentration risk, competitive environment. We're trading at a high multiple. If it's that risky, shouldn't we be trading at a lower multiple? Or why do you think the current multiple makes an attractive entry point?
So their two like biggest customers are Microsoft and Meta. And in 2022, they did make up a very large portion of their revenue. But we believe that like as they have better equipment, that they can gain more market share. And they also have like smaller purchases from Google. I'm blanking on the other ones, but just not as big of a portion as Microsoft and Meta.
But it's the cloud providers, it's not the cloud consumers that are purchasing Arista.
Correct. Yes.
Let me just, because I've got a point on top of what he's asking. Right. So along the lines, I was kind of wondering, it's a lot of the same things. I mean, I actually wrote exclusivity and product stuff. We talked a lot at the beginning about just how competitive the industry is, Cisco this, Cisco that. What is Arista's competitive advantage, do you guys think, in the marketplace? When they sit down at the table across from Meta and from Microsoft, why buy from them versus anybody else?
So Arista, their main focus, their main business are the switches, whereas Cisco, only some of their business are the switches, and then a lot comes actually from their like telecommunication equipment too. So Cisco is more diversified, Arista is more focused on just the network switches. And then their service, the EOS.
Cause I'm just like, so if they're very focused on that. They could, I mean, if I was a salesperson with them, my pitch would be. I have a better product because this is all we focus on. But then counter to that is, well, if you're so good, then why are you only in these two big guys and you're not a bigger component piece of Google and Amazon, et cetera, et cetera. So I'm trying to understand what is their competitive place within the market, or where is their advantage within the marketplace if they can actually go to these other places and win business? Like what, as you listen to them talk on the earnings call, what are they, these areas that we think we can win business? So that's gonna keep the growth going, right?
Right. So I believe they acquired Microsoft and Meta as customers in 2018 for the first time. So we've seen they skipped upgrades in 2020 because a lot of companies cut spending. So and then in 2022, that's when they upgraded their equipment again, and Arista saw 40% growth in their profits. But along with that, their service as well. They're kind of still breaking into the industry. They went public in 2014, founded in 2008. So having the two large customers like that, there could be a chance that Amazon and Google start purchasing more of their equipment depending on how they like it or not. Like right now, I believe it's more of like in the test phase. So I don't know if they use Cisco equipment right now or if it's more Arista. I think it's more of the competitors compared to Arista, but with the products they've been launching recently and the vast like the scale that they have and what they want to release now, we believe they're kind of staying ahead of the industry.
And just one quick follow-up on something you mentioned. So you said they bought the equipment initially in 2018 and they just did a refurbish in 2022.
Yes.
So is that schedule going to remain going forward every 4 years? It's kind of a big refresh.
It's normally every two. They skipped 2020 because of COVID.
Because where I'm going with this is I'm wondering about the volatility of their earnings. If it's every 2 years, you see a big spike and then you see it down, and then you big spike in earnings and then back down.
Right.
If it gets pushed out, then it's even more of a push. Then you're actually losing business because you're losing 2 year.
Right.
Sorry.
No, I just continue that.
No, hold on.
Oh, it's one of you? I'll come back to it then. Go ahead.
At the very beginning of the presentation, you said there was earnings call and the share dropped 15%. That seems non-trivial to me. What happened? We haven't addressed it, but given the risks that they're discussing, I can't get that. I can't get past that and look at the rest of it.
Right. So the reason they dropped 15% is because they're skeptical about cloud computing in the future. We believe that it's going to keep growing, but there have been reports that the big cloud titans are going to start kind of cutting spending. I think part of the reason is because there's a recession in the loom, so they want to make sure that they'll be able to make it through and make sure their stock stays at a decent price. But along with that, that's going to cause them to start cutting spending in some areas. And unfortunately, that would be in their cloud computing areas.
So you were attributing that large of a stock dip to a potential economic, it's not, they're losing Microsoft as a partner.
No, not losing any partners or anything, just cutting spending a little bit. Yeah, in quarter one of this year, they beat their revenue by $250 million, beat the estimates by that. And then their earnings per share, they beat by about 0.07. So they had a great first quarter, but their stock fell because of the future outlook.
Along that lines, because I saw the same thing. I saw the stock price, and I want to go back to that chart because I missed the part that you heard. I just saw the stock price chart, and I'm like, okay, what the hell happened there? So did you guys actually go and listen to the big guys and or looked at any research as to what they're actually saying about what their cloud expectations are moving forward? Because I think that's what I mean, if you looked at any of those reports, that was the one thing everyone keyed on was essentially what's their cloud growth look like? And their stock price the next day pretty much followed whatever they said.
Yeah,
So I'm curious.
for the next 5 years, Microsoft, Google, Meta, and there's one other one. They're expecting growth rates in the cloud industry to be between 35 and 50% each year.
How is that compared to the last, like, what's the trend? Sorry, that's the better question.
So I believe it's roughly flat, the growth rates.
Yeah.
I believe the last 5 years, for cloud growth has been, 35%.
So it's actually gonna go up based on what you just said? So if this last 5 years is 30%, you said it was gonna go.
I believe,
35 to 50,
it was more skewed towards like 35%, for the future growth.
but you're
those
saying, but
companies.
you think it's gonna pick up in spending? Based off what you just, if I'm catching this right, if I'm wrong, just tell me now.
Yes, but that's just their growth rate. For our EPS, we did a pretty significantly lower growth rate than that.
Yeah, can you actually go to that slide where you guys did your pessimistic and optimistic? Okay, I was just trying to follow all the numbers on the screen, and what threw me off was the pessimistic decreased by 1, and I looked up and I saw the other two decreased by 2%, which are coming off of a higher base. So I was trying to get them, I wanted to kind of pick your brain on the methodology as to how you came up with those growth numbers.
Yeah, so starting with the optimistic, we do have that slightly higher than Arista Network's previous 5-year growth rate, just for in 2023. We do have that going down. We just wanted to be conservative with this. And if we had it higher, like if we kept it at what the industry growth rate, the prospected, and what the historical growth rate has been, we got too high of valuations.
I'm just doing the math in my head, because I'm starting at 18%, and then you get your terminal growth rate. How many years out is that?
That's after 2026.
It's probably close enough. I was mentally doing that, it's like off 1 or 2%, and it's probably all around. So no big deal, sorry.
Which slide where you compare the three? No, the 3 stocks. Juniper, Cisco. So why wouldn't we buy Juniper or Cisco on this one? Is there if you have to pick one of these 3? And just, we've got 30 seconds left. Why Arista and not one of these other 2? When I'm looking at lower price to book, lower PEs, higher return on equity there, higher return on assets there. What makes this one more attractive, do you think, over the next 3 to 5 years?
I think they're gonna be able to maintain their high profitability, which will allow them to have excess cash. Their debt to equity, they don't issue any long-term debt, so whenever they make acquisitions, they make about 2 every 2 years. They issue stock for it instead of taking on debt, and then they buy back that stock relatively quickly. So they made acquisitions in 2020, and then in 2021, third quarter, they did a $1 billion buyback of the stock throughout the rest of 2021 and 2022. So they're able to repay their debts very well, and I believe they're in the right direction with their products and staying ahead of the game.
The biggest thing with that really is just what we view as their future opportunities for growth are much higher than Cisco or Juniper's at this moment.
So the premium, when we look at the price to earnings multiple, is justified.
In that future growth estimate, yeah.
And you guys made comments about the optimistic versus the baseline PEs, and how I think the optimistic PE was lower than the baseline. How did you come up with those PEs? Just out of curiosity, how did you make that decision that the optimistic was.
So, yeah, we looked at their historical growth rate over the last 5 years. On average, I believe it's been growing at 6% a year. So we do have it growing slightly higher the first year. But then we do go back down to around that level. We believe that it can be higher than that just because of the AI growth that we believe is gonna be starting around 2024.
When you say growth, said growth at 4% or 6%, what was growing at 6%?
The historical PE,
So the PE was expanding by 6%.
yes.
So PE, price over earnings. The price is expanding. The price of the stock is expanding 6% faster than the underlying earnings.
Mhm.
So meaning investors are. You see, like if a PE is expanding, what does that mean to you guys?
Optimistic about future earnings.
And then if you're optimistic, you've got the PE less than what you'd be on your baseline. So what's the methodology? Like, what was the thought process? And again, I'm really struggling with this, and that's me because I'm not that smart.
So we had higher growth rates for earnings and are optimistic for 2023.
Mhm.
And that's the majority of the reason for the lower PE in that scenario.
So if you're looking at your price, your earnings. I'm stuck.
I think it's formulaic, not.
Yeah.
Oh, there's an optimistic scenario, so not only are earnings higher, but we're also gonna slap a higher PE on it.
Yeah, but
If earnings are higher, which de facto, the PE ends up being slightly lower.
that's based off of a 172 price, right?
And 553, yes,
I know, but you're going backwards, right?
I'm looking backwards from right to left.
How do you think people in the real world do this? Like, do you?
No, you didn't.
That's my confused. So historically, from my seat, you figure out what you think the EPS is first, and then you figure out what you think the right multiple is, and then you get to the price. Well, this looks to this point like you're going backwards. Like it doesn't make sense. It just doesn't make sense to me, I guess, and I don't know how to go any farther. If one of you guys can say it more eloquently.
No, I think if you're in a more optimistic scenario, the market is giving you a higher premium.
They think you're gonna have that growth, so it's
Yeah,
like, all right, we're
so
gonna pay them.
So you go the
On
other
the
way.
opposite of what you saw that happened a week ago, 2 weeks ago, when the price fell, right? You're thinking what's going on in the future. Oh crap, growth isn't gonna be there. We're gonna cut your price, and I'm guessing, part of the PEs might have took a hit too. Because it just depends. Did the earnings expectations come down more than the price, or the price come down more than the earnings expectations? It's a lever, right? So. I don't know. Keep going.
No, so then when, all he's saying is you'd start with that earnings per share and say EPS is 553, that's more optimistic. Not only are we more optimistic about the earnings, but we think the market is gonna be more optimistic about the outlook and maybe give them a 33 PE or something.
And it
like
doesn't
that.
have to be like that, but
A lot of times that's what you see.
a lot of times that's what happens, but you could say,
Just a quick, this is more of a, I want to applaud you for putting some numbers on something that you have no basis for, but to look at the AI piece and go, we don't have anything, but we're gonna give them credit for this because it's gonna be a component here. I don't know if those numbers are right, but I appreciate there was some thought going into this is a growing part of their business. It still only represents about 10% of the total earnings, but we have to put it into our model somewhere.
I should add to that. So for our AI growth, we didn't include that in our baseline scenario. We just included that in our optimistic scenario.
that's good. That's a good way to do it. Who was your, did you guys come up with that idea on your own, or did your